Welcome to the Global View. On this Tuesday, US Treasury yields have risen ahead of key employment data due later this week, although traders are pricing in the likelihood of the US interest rates will be cut as soon as March, following dovish comments from Fed officials last week. The 10-year yield rose to 4.28% after dropping last week to their lowest level in 3 months, the 2-year gaining 9 basis points to 4.65%. And the US dollar has regained some lost ground after falling for 3 straight weeks on assumptions that the Fed's next move will be to cut rates. The Aussie dollar down around 1% or so overnight. That is ahead of today's Reserve Bank Board decision, with it widely expected to keep rates on hold at 4.35%. Well, for more on the macro globally and how it's shaping equity strategy, I caught up with Budaghyan from BCA Research.
I think the story in financial market in the past 1 month has been soft landing narrative has dominated. Risk assets have rallied quite sharply. Dollar is down, bond yields down because kind of Fed and other central banks will be in position to ease policy. So narrative is a soft landing. I would like to kind of make one point. All landings start as a soft landing initially. So just because market is discounting soft landing and data have been on soft side, it's not collapsing, it's weakening. But no landing starts abruptly collapsing. Most landings start initially as a soft landing, and some of them become a recession. Some of them remain soft landing or mid-cycle slowdown. So it's a judgment call right now. Are we going into some sort of a recession, or it will remain a soft landing? In our former case, stocks have very limited upside and meaningful downside. If global economy indeed delivers soft landing, specifically US in this case, this rally could continue for a while.
All right, well, Arthur, let's first then focus on what we're seeing in the States, where you see the economy tracking at the moment, because of course futures markets pricing in the first rate cut as early as March. Is that realistic to you?
That's realistic only if we're in a recession by March. If S&P below 4,000, US economy in a recession, unemployment rising sharply, yes, Fed will start cutting in March. However, if US economy is not in a recession and S&P is meaningfully above 4,000, Fed is not going to cut rates in March. So I think the way bond and equity market are trading inconsistent. Either bond market is correct or equity market, but I don't expect both of them be correct for projecting rate cut in March.
Well, so what data are you watching that may give you a sense of where the US economy is likely to track, certainly into the first half of next year?
So we're looking all available data. There is no 1 or 2 data points that kind of we rely only. And there have been quite some data has shown quite a bit softness in recent weeks. For example, there is a Fed survey of business conditions across US, and that monitor indicator has fallen below 0 first time in past few years. And there are some other surveys indicators that we're watching, and it suggests that US economy consumption trend in US economy has downshifted in recent weeks. And I think that's consistent that US economy is slowing down, but I'm not sure it's a consistent weakness has been enough for Fed to start cutting interest rates. So again, if US economy is not in a recession, Fed will stay higher for longer. In that case, bond market is not going to be correct. If US economy is going to be in a recession in early 2024, in that case, bond market will be right and bond yields will keep falling. However, equity market is mispriced in that case.
Well, when we take a look at the US equity market, of course, at least for the first half of the year, it was very much driven by the Magnificent Seven. It was very narrow leadership there. More recently, of course, we've seen that breadth of gains. Is that encouraging to you?
Yeah, some technical measures have improved drastically in terms of breadth. However, it's just one month of a market move. Market has priced narrative, and positioning was light has become kind of elevated again. I would say is not long enough to make me to change my view. And my view that U.S. growth is going to slow down and U.S. equity market is going to struggle. So yes, some technical indicators have rebounded, become positive, but overall, in my opinion, is not enough to change the view.
Arthur, let's move now to Europe. What are you seeing in the Eurozone? Of course, it is struggling in terms of growth there. Particularly, you look at the largest economy, for instance, Germany, certainly under pressure, particularly as far as its manufacturing sector is concerned. What's your outlook for the Eurozone?
I think a European economy is in much weaker position than U.S. economy, and I think Europe will enter recession earlier than U.S. And that's why I believe euro is a sell after recent rebound. So in fact, I would say U.S. economy will be one of the last ones to enter recession globally. That's why I think dollar will resume its rally. So I'm still quite positive in U.S. dollar. In terms of Europe. Interest rates are restrictive, global trade manufacturing are contracting, and Europe being much more manufacturing oriented and facing high interest rate is struggling much more than US economy. So Europe probably going to be in a recession in very near term. Germany already flirting with a recession, and the rest of Europe will converge towards Germany.
All right, Arthur, to Asia. Now, of course, from an Australian perspective, we're very much focused on what we're seeing in China at the moment. Are you confident that you've seen the lows there? What's the latest data telling you as far as perhaps something of a rebound in China?
I think the way I can characterize Chinese economy is the following. Economy is not crashing, but it's very weak. It's very weak by Chinese standards. Growth is not improving despite economy reopening. But the economy has not been crashing either, so there's no economic crisis or collapse in China. And that's why government is not panicking yet. Government kind of is not providing irrigation style stimulus. And I think if that continues, growth will continue being disappointed. Again, I'm not sure Chinese economy will crash because it hasn't really recovered post-pandemic. Something can go down when it has gone up. Chinese economy hasn't even improved meaningfully post-pandemic, so that could be kind of a no collapse. But I believe growth expectation in China will underperform, and China-related plays in financial markets will go down in absolute terms.
And also in that region, Korea. What are you seeing with South Korea at the moment? Perhaps struggling, particularly as far as its, well, it has seen exports increase there, but what are you seeing particularly as far as domestic demand? What's your outlook in Korea?
Yes, I think Korea is a very interesting macro case because it has very large manufacturing and export sector. Exports make 40% of GDP. And what happens with Korean export, it's often indicative of a global business cycle, global manufacturing and a trade cycle. And indeed, Korean exports have improved last few months from after contracting at double-digit rate. They are kind of very marginally positive, and many investors are taking that as a sign of budding recovery in the global trade, global growth. However, I think situation is somewhat different. The way I read Korean data, is especially in terms of export data, is the following. In a business cycle expansion, there's a notion or concept of a mid-cycle slowdown. And I think the same happening in Korea, but in an opposite way. In any downturn, could be mid-cycle improvement. And I think what we see with Korean exports, it's a mid-cycle improvement in Korea. But is it happening within context of broader downturn contraction in global trade, Korean exports? So my bias that improvement in Korean exports that we have seen in the past couple of months is going to be transitory, and Korean exports are going to start contracting sometimes probably early next year. In terms of domestic demand, things are quite downbeat. Retail sales are contracting. Service activity has slowed down very sharply. And overall, consumer is going to struggle in Korea because the same interest rates have gone up a lot. Korean consumers are very leveraged. They have a lot of debt. And most of that, it's a variable interest rate debt. When variable interest rates have increased as much as they did in Korea or many other countries in the world, consumers struggling with higher borrowing costs are going to struggle keeping their spending on a level of previous years.
And just very briefly, Arthur, almost out of time, but staying in that region, Japan. Are you expecting the Bank of Japan to alter its policy at this point?
I think there was a very good case for Japan to start tightening monetary policy in the last 12 months, given they have not done it, and Japanese experts are beginning to contract it, and the rest of many other central banks around the world are going to stop hiking interest rate tightening. I'm not sure Bank of Japan will go and start hiking interest rate in a meaningful way. So I think they have. Basically, they haven't done it when they could have done it. By now, it's already time running out, and I will not be surprised if Bank of Japan doesn't do much, neither easing or tightening monetary policy.
That is the outlook from Arthur Budaghyan from BCA Research. That is the global view. Just before we go, a check. We are expecting to open low, as you can see, SPI futures off more than 0.5%. Stay with us. The open just a minute or two away.